Hi everyone. Uh, in today's class, we are going to be treating basically the modified internal rate of return, project duration, discounted payback period. So if time still permits, we may likely treat um, non-discounted cash flow method of investment appraisal. But our focus for today's class would be to treat modified internal rate of return, project duration, and then the discounted payback period. All right. So before we commence the class, please try as much as possible. Lest you forget, if you have not subscribed to the YouTube channel, please, I encourage you to do so immediately so that as soon as I'm uploading new videos like this nature, they will be able to receive notification and you can also share with your friends and colleagues so that they too can benefit from the valuable videos we have on the channel. All right then. So in our last class, we discussed the concept of uh, capital budgeting. We started with introduction to capital budgeting. We also treated the procedures involved in carrying out capital budgeting decision. Not only that, I also explained the characteristics of capital budgeting. Then we started thereafter we moved to discussing the methods of project appraiser. Okay, so we have discussed so far um, net present value, internal rate of returns. Then we also the last area that we discussed was the areas of conflicts between the decision of NPV and then the internal rate of return. So in today's class, we are going to be we are going to start with modified internal rate of return. You will recall that in our last class, I mentioned that the internal rate of return is kind of one of the limitations of IRR is because of the fact that it's subjective, okay? Because there is no specific rates that you can have, there is no specific rate that you can, is in between two values, so it's not exact. So as a result, and because of the fact that you are the one that will assume the discount rates to be used to discount the future expected cash flows while calculating the internal rate of return. So because of that, a new technique was developed, which is the modified internal rate of return. However, when it comes to modified internal rate of return, there are some specific things you need to understand. For example, when there are unconventional cash flows, the unconventional cash flow are cash flows that involves both positive and negative. Okay, say for example, you have cash flow in year one. Okay, year one, year two, year three, then year four. These are cash flows. I mean, these are number of years. Then you are now given a cash flow for year one. Say for example, this one is 5,000. Okay, in year one, positive cash inflows. Okay, in year one is 5,000. In year two, you are told that there's a cash flow of 1,000. Okay, in year two. In year three, there's a cash flow of 500. Then in year four, there's a cash flow of 1,200. When you look at this, we have both positive and negative cash flows in between the years. So this is what we call unconventional cash flows. So where there are unconventional cash flows, it is not suitable for you. It is not suitable to use internal rate of return as a decision criterion because of the fact that it will be conflicting with the decision of NPV, net present value. So as a result, will not be consistent with the shareholders' wealth maximization objective. So the generally the underlying assumptions behind NPV is the fact that the cash flow generated by the project can be reinvested at the company cost of capital. However, the internal rate of return assumes that no, the cash flow that the future cash flow that the project will generate should be reinvested at the internal rate of return. So this is an apparent conflict between NPV as well as the internal rate of return. So as a result of this, the modified internal rate of return has been developed to correct the anomalies associated with the internal rate of return, because any discount rate that doesn't have the same objective with the net present value may be deemed to be antagonizing, or will be deemed to be against the objective of shareholders maximization. So as a result, this new technique, which is modified internal rate of return, has been developed, and then the MRR is the rate that is consistent with the shareholders wealth maximization objective. How? Because the IRR also assumes that cash flow generated by the project can be reinvested at the company cost of capital. So this modified internal rate of return is designed to allow the decision maker to specify a different reinvestment rate for each receipt and payment associated with the project. So in order to correct the errors, in order to correct the shortcomings associated with the internal rate of return, that is why the modified internal rate of return was developed. Okay, so what are the advantages of modified internal rate of return? Of course, you can quickly go through this on your own. Okay, so I don't want to, however, let me just mention a few of them. Number one is that it eliminates multiple IRR. Okay, it eliminates multiple IRR rates, because the internal rate of return itself will always have multiple, because when you draw the graph, so you are going to pick in between two rates is what you are going to is what the internal rate of return will fall into. So as a result of that, this modified internal rate of return will eliminate that, so there will be nothing like that again. The second advantage of modified internal rate of return is that it produces a result that is consistent with the NPV decision rule. Okay, it produces a result that is consistent with the, so any project that NPV supports, any project that NPV suggests that it should be accepted, the same thing modified internal rate of return will do. All right. Again, it reduces over optimism of IRR. It provides a percentage rate of return usually preferred by a non-financial manager relative to monetary or absolute amounts produced by the NPV. So these are some of the some of the benefits of a modified internal rate of return. However, what are the methods? Okay, what are the methods of determining modified internal rate of return? Basically, there are two methods of calculating modified internal rate of return. You can either use terminal value method or you use present value method. Whichever of the two methods that you use, you are going to get to the same answer. However, at all times, the present value method should be used, especially if, of course, on the day of your exam, at the back of your question paper, the formula, the modified internal rate of return formula that will be given to you it's expected that you are going to use the present value method. Okay, so I will show you later on as we proceed in this class. All right. However, when you want to calculate modified internal rate of return using terminal value method, there are three stages, there are three procedures that you are going to carry out. Number one is to calculate terminal value for all the positive cash flows. All right. You are going to calculate terminal values for all the positive cash flows. How do you calculate your terminal values? I will show you. So once you are done with calculating the terminal value, the next step you need to do is to calculate present value of negative cash flows. All right, calculate present value of negative cash flows or cash outflows. Then step 3 is to calculate modified internal rate of return using the modified internal rate of return formula. Then step 4, you can advise on the acceptability of the project. Okay, so yes, like I've explained, this method relies heavily on the positive cash flows generated by the project, and with the assumption that the cash inflows can be reinvested at the reinvestment rate or at the company cost of capital. All right, because your intention of using terminal value is that the cash flow generated by the project, you want to reinvest it, which is consistent with the definition of a modified internal rate of return, which assumes that the cash flow generated can be reinvested at the reinvestment rate or at the company cost of capital. Okay, so I've already explained the procedures. Now, when you want to calculate the modified internal rate of return, okay, so like I said, the first thing you are going to do is to calculate terminal value for the positive cash flows. Okay, you calculate terminal value as if you want to compute NPV. However, instead of you to discount the cash flows, all right, instead of you to discount the cash flow, you are going to compound it because your intention is to reinvest the cash flows generated by the project. So just as if you want to calculate NPV or present value, okay, it's the same format, the same table. Therefore, say for example, this project has 3 years life and there are three positive cash flows for each year. So you are going to indicate the cash flow for each year. Say for example, in this one, so you want to reinvest this cash flow of year one. How many more years can you reinvest it? And that's why you are compounding it. How many more you want to reinvest? Your assumption is that the cash flow generated in the first year, you want to reinvest it. So how many more years can you reinvest it? Because each cash flow that you are seeing here, the cash flow for year one, for year two, and year three occur at the end of each year, 12 months after. So in that case, you want to reinvest the cash flow of year one. How many more years can you reinvest it? So you can only reinvest the cash flow of year one for additional 2 years, because the year the cash flow occur is not part of it. So there are 2 more years, and then that will be for year one, year two. In this case, when I want to calculate my compounding factor, I will just say 1 plus r raised to power 2. My n will be equal to 2, or you can say 1 plus r raised to power n minus 2. The n is the useful life. One is the for each year that you want to do. This one, for example, this one will be 1 plus r raised to power n minus 1 year. The year that cash flow occur is out of it, so n minus 1. Then when I get to the second one, I will say 1 plus r raised to power, of course, instead of me to say n in this case, I will just say, okay, let me leave the n like that, n minus 1. And in this way, I will say n minus 2, because I'm talking about cash flow of year 2 now. That's why I put n minus 2. So the n is the useful life, which is 3 years. So when I get to the third year, I will say 1 plus r raised to power n minus 3. So that will be 3. Then in the last one, your n will be equal to 0, because say for example, the useful life of this one is 3 years. 3 minus 3 will give us 0. So that is what you are going to do. Then in your own calculator, what you are going to do is you are going to start from the compounding factor. Say for example, the cost of capital or reinvestment rate is 10%. I will say 1.1 raised to power 3 minus 1 equal. I will get my answer in the calculator. The answer you have in your calculator, just use it to multiply the cash flow. Then you come and post. That's the terminal value. You do the same thing for year 2. You do for year 3. You add everything together. That will give you the terminal value. Of course, we are going to demonstrate it with live question. Then, of course, when you are calculating the terminal value, please, you don't include negative cash flow. You don't include the terminal value. The terminal value only consider positive cash flows. So when you have negative cash flow in between years, remove the negative cash flow. It shouldn't be included. Okay, negative cash flow should not be included. Then step 2, I said you should calculate the present value of all the cash outflows. Okay, calculate present value of negative cash flows using the company's cost of capital. At times, examiner may give to you the company cost of capital and the reinvestment rate. So when you are calculating the terminal value, where you are given cost of capital and the terminal and the reinvestment rate, please use the reinvestment rate for the positive cash flows when you are calculating terminal value. However, when you want to calculate the present value of the negative cash flows, use the company cost of capital, because you are not reinvesting it. Because you want to reinvest, that's why you are calculating terminal value. So as a result of that, you should use the reinvestment rates, not the cost of capital. But where you are given only cost of capital, then use cost of capital for all. All right, so that's for that. Then step 3 is for, of course, you know how to calculate present value already. We have done it under NPV. So just multiply your cash flow with the discount factor to get the present value for year 0, and also if possible, if you have negative cash flows in between the years. All right, so you also calculate present value for that. Then step 3 is to calculate the modified internal rate of return. So to get the modified internal rate of return, you can either use this formula. This is the example I used for the last class. Okay, let me remove it. Okay, so yes, either you use this or you use this, you are going to get the same answer. All right, so that's the third step. It is the third procedure you are going to carry out whenever you want to calculate modified internal rate of return using terminal value, or second procedure. Okay, now if you are not too good, if you don't know how to use calculator for second function, okay, then it's better to concentrate on this one. Use that one. Okay, use that formula. So this will be more straightforward. The DO is the terminal value. The DN is the present value of cash outflows. Okay, present value of negative cash flows. N is the useful life of the project. So that's that. Then of course, before we go to the decision rule, if you want to use the present value, again, there are 3 procedures you are going to carry out whenever you want to use present value to calculate the modified internal rate of return. The first thing first you need to do is to calculate present value for positive cash flows. Then you calculate separate. Then you calculate, second step is to calculate present value for all the negative cash flows separate. Then step 2 is to proceed. Step 3 is to proceed to calculating the modified internal rate of return using the modified internal rate of return formula. Now, this is the big for nothing formula that you are going to use to calculate the modified internal rate of return. On the day of your exam, this particular formula will be given to you at the back of your question paper, but it is not called present value of cash inflow over present value of cash outflow raised to power 1 over n. It is called PV of return phase, then PV of investment phase. All right, because the return phase is when the project start generating revenue or benefits to the company. All right, when the project start generating benefit or end benefits, so that is return phase. That's the cash inflow. The money is coming in. But when the company is spending money on the project, that is the investment phase of the project. When the company is pumping money, spending money on the project, that's cash outflow. It means that the company is spending money, cash is going out. The company is investing on the project. So that is investment phase cash flows. Therefore, when you want to calculate your modified internal rate of return, whether you call it PV of return phase, or you say PV of cash inflow, because cash inflow you are familiar with it. So just say PV of cash inflow divided by PV of cash outflow raised to power 1 over n. N is the useful life of the project. Then multiply by 1 plus R. R is the reinvestment rate or cost of capital of the company. You put everything in brackets, then you less 1, then multiply with 100%. That will give you the modified internal rate of return. Then this is how to calculate modified internal rate of return. So the next thing we are going to talk about is the decision rule under modified internal rate of return. So for the decision rule for modified internal rate of return is consistent with the decision rule of the normal internal rate of return. So the project should be accepted if the calculated modified internal rate of return is greater than the company's cost of capital. Provided the calculated modified internal rate of return is greater than the company cost of capital, the project should be rejected. But if modified internal rate of return is less than the company cost of capital, the project should not be accepted. However, where the modified internal rate of return equal to the company's cost of capital, the company can either accept or reject the project depending on other qualitative factors. However, if you are asked to advise on the acceptability of the project where there are mutually exclusive projects, of course, any project with a higher modified internal rate of return, provided it is greater than the company cost of capital, should be accepted. So that's the decision rule for modified internal rate of return. Let's have a short examples to demonstrate what I've just discussed. So let's try this example number 1. Are you ready? All right then. So Filipino PLC is considering an investment in a project which requires an immediate payment of 150,000 naira, followed by a further investment of 54,000 naira at the end of the first year. The following are the expected future cash flows. All right. So these are the cash inflows the project will generate year 1 to 5. It is expected that the return phase net cash inflows will occur at the end of each year. So this is the question. No matter how big is the question, it is the same procedure for calculating modified internal rate of return. Just understand the concept and then including the formulas. So no matter how examiner tweak the question, then of course we are going to get to the right answer. However, if you don't understand the concept, you are going to struggle, all right? But it's very straightforward. So now I want to calculate modified internal rate of return. There is no need for you to be using the two methods. You can, if you want to use terminal value, be consistent with terminal value. Don't go and be using terminal value, then you now demonstrate showing too much scales, then you now demonstrate for using the present value method. Please, only one method is expected that you are going to use, so that don't say. But in this particular material, in this class, we are going to demonstrate the two methods so that you will see that whichever of the two that you use, you are going to get the same answer. All right. So let's follow those three procedures I mentioned. If you want to use, for example, you want to use a terminal value method. So like I told you, there are three procedures. All right. The first procedure is to calculate terminal value for the positive cash flows. Then step 2, calculate present value for the negative cash flows. Then step 3, calculate modified internal rate of return. If you want to include step 4, you are advised, because examiner is asking you calculate the modified internal rate of return, assuming the return rates and the reinvestment rates equal to the company cost of capital of 8%. Even though you are not asked to advise, then you can state your advice. That will be step 4. Okay then. So the name of the company, at all time, once you are given the name of the company, always start from there. The name of this company is Filipino PLC. What do you want to do? You want to calculate modified internal rate of return. You also need to indicate that. All right. Especially this will help the whoever that will be marking your script to know the question that you are solving, even though you have indicated it in the exam booklet. Then, of course, on the day of your exam, don't go and say calculating modified internal rate of return using terminal value. Don't say that. Just go ahead, solve whatever you need to solve. Don't go and indicate. Don't go and indicate using terminal value. Just ignore that information. It's because of explanation. That's why I have to do it this way. I want you to understand it so that you know what we are doing. That's what I say, using terminal value. On the day of your exam, ignore that information. Don't go and say using terminal value. Just go ahead. So like I told you, when you want to calculate terminal value, it's as if you are calculating normal present value. However, when you are calculating present value, you are supposed to discount the future cash flows. But in this case, you are compounding it, you are increasing it, you are inflating it. All right. So that's what we want to do. So the cash flow, the positive cash flow for year 1 is 65, year 2 is 77,500, year 3 is 57,500, year 4 is 47,500, year 5 is 37,500. Remember, the assumption behind modified internal rate of return is that the cash flow generated by the project can be reinvested at the company cost of capital. So the cost of capital is 8%. Therefore, we want to reinvest the cash flow generated by the project. Therefore, the cash flow of 65,000 naira in year 1, we want to reinvest it. Remember, all these cash flows will occur at the end of each year, that is after 12 months. Therefore, the cash flow of year 1 of 65,000 naira after year 1. So we have year 2, year 3, year 4, year 5. 4 more years. You can reinvest the cash flow of year 1 4 more years. And that's why we are saying the cost of capital is 8%. 1 plus 8%, that will give us 1.08. So how many more years can I reinvest the 65,000 naira? 4 more years. Remember what I told you the other time? It is, you can say 1 plus r raised to power n minus 1 In this case, I will say 1.08 because my R is 8%. So raised to power, the N is the useful life. Useful life is 5 years minus 1. This cash flow of 65 occur in year 1. I will say minus 1. Okay. In this case, that will give me 1.08 raised to power 4. That's why you are seeing that raised to power 4 here. If you don't want to follow this route, just do the calculation yourself. You want to reinvest the 65,000 naira. The year 1 is out of it. How many more years can you reinvest it? You have additional 4 years. That's why you are seeing that 4 there. Therefore, I will then bring out the calculator. I will say 1.08 raised to power 4 equal. So what I have in my calculator, I will not restrict my number. What I have in my calculator multiplied by the cash flow of that year, 65,000 naira. So this produces 88,432. That's the 88,432 you are seeing here. Again, I'm done with the first year. I will go to the second year. The cash flow of year 2 is 77,500. How many more years can I reinvest it? Year 1 is gone. Of course, this cash flow occurred in year 2. So year 2 is not part of it. So I have year 3, year 4, year 5, 3 more years. That's why you are seeing the raised to power 3 there. So for me to now get my terminal value, I will then say 1.08 raised to power 3 raised to power 3 equal, then multiply by 77,500 equal, that's 97,628. That's how we got this number, 97,628. Then I'll move to year 3. How many more years? The cash flow of 57,500 are occurred in year 3. How many more years can I reinvest it? Year 3 is gone. I have year 4 and year 5. Therefore, that's 2 years. Okay, that's 2 years. That's why you are seeing 1.08 raised to power 2. Then I would carry my calculator. 1.08 raised to power 2 equal, then multiply by 57,500. This will produce 67,068. That's the number there. Then I will go to the fourth year. In the fourth year, the cash flow is 47,500. Okay, how many more years? Year 4 is gone. I have only year 5, so that's only 1 year. That's why you are seeing this one raised to power 1. So in this case, I would then say 1.08 raised to power 1 equal, then multiply by 47,500. So that's 51,300. That's how we got that number. You can see the way it's flowing. It's not difficult, very straightforward. No matter how big, let examiner scatter the question for you. But the bottom line is that once you're able to get your relevant cash flow correctly to calculate your NPV, modify internal rate of return, anything you want to do, once your net cash flow is correct, every other one is very straightforward. All right, so the final one, which is year 5, this 37,500 occur in the 5th year. How many more years? That's the final year. So of course that will be 5 minus 5. That will be equal to 0. So anything raised to power 0 is equal to 1. That's why you are returning the cash flow there. Then you add up everything, add up all the terminal value. You add up all the terminal value, and that's what produced 341,928. So I will keep it on one side. Then I will then go to step 2. Step 2 says you should calculate the present value of negative cash flows. I want to calculate the present value of negative cash flows. Negative cash flow is the same thing as cash outflows. All right. So in this case, when you are calculating present value, you are expected to discount. Therefore, I will then go to the question. What are the negative cash flow given to me? Examiner has told me the question that this project will require an immediate payment of 150,000 naira. That's initial outlay. This is initial outlay, followed by a further investment of 54,000, further spending of 54,000 at the end of the first year. So there is a cash outflow in year 0 and as well as year 1. So I will then calculate my present value for negative cash flow in year 0 and then in year 1. There is no need for you to come and put it in brackets. You've already said cash outflow. So if you put it in brackets, that's tautology. So there's no need for you to do that. Therefore, I would then say, okay, of course, 150,000 in year 0 multiplied by 1 will give us 150,000. Then in year 0. Then in year 1, we have cash outflow of 54,000. So at 8%, discount factor in year 1 is 0.9 26. You already know how to calculate discount factor. It's 1 plus r raised to power minus n. In this case, that will be 1.08 raised to power 1 minus 1. So this will give you 0.926. That's how we got it, 0.926. All right. When you multiply with 54, that will give you 50,000. 50,000 plus 150,000, that's 200,000 naira. Okay. Now I've calculated the terminal value for positive cash flow. I've also calculated the present value of cash outflow. The third step is for me to calculate the modified internal rate of return. Calculating the modified internal rate of return, because I'm using terminal value. Like I advise you, if you don't know how to use second function in your calculator, always use this particular formula. All right. DO is the terminal value, and the terminal value we got was 341,928. That's the 341,928. The PV of the negative cash flow is 200,004. So that's the 200,004 you are seeing there. So mathematically, you don't need to waste your time and be doing it step by step like I did in this material. All right. Of course, 1 divided by n. N is the useful life of the project, and the useful life of the project is 5. Therefore, in my calculator, I will just say, in my calculator, let me push it to the other side. So in my calculator, I will just say 1 divided by 5 is 0.2. I know 1 over 5 is 0.2. Therefore, I will just say 341,928 divided by 200,004. Okay, equal. So I don't need to waste my time. I'll just say raised to power 0.2 equal. That's 1.1132, whatever, then minus 1 equal, multiply by 100% equal, that's 11.32. That's how we got this 11.32. You can round your number to 11%. This is how to calculate modified internal rate of return using terminal value method. So if I want to use present value method, I will still get the same answer. However, using present value method, there are 3 stages that you're going to carry out. The first stage is to calculate present value for positive cash flow. Step 2, calculate present value for negative cash flow. Then step 3, calculate modified internal rate of return using the second big for nothing formula that I mentioned the other time. Therefore, we have already calculated present value of negative cash flows. So let's calculate present value of positive cash flows. So the positive cash flow given to us in year 1 is 65,000 naira. Discount factor at 8% for year 1 is 0.926. When you multiply with 65,000, we have 6190. I will move to year 2. The cash inflow for year 2 is 77,500. Discount factor at 8% for year 2 is 0.857. Multiply with 77,500 will give us 66,418. So we are moving steadily. Then in year 3, cash inflow given is 57,500. Discount factor at 8% for year 3 is 0.794. When you multiply with 57,500, that will give you 45,655. In year 4, we have cash inflow of 47,500. Multiply with cash inflow discount factor of 0.735. That will give you 34,913. Then finally, year 5, cash inflow is 37,500. Multiplied by discount factor at year 5. Discount factor of year 5 at 8% will give you 0.681. So 0.681 multiplied by 37,500, that will give you 25,538. When you add everything together, the total present value will then be equal to 232,714. So then step 2 says you should calculate the present value of cash outflow. We've already calculated present value of cash outflow to be 200,000. This is it here. So we've already calculated this. So in this case, all I need to do is to slot into the big for nothing formula. This is the big for nothing formula. Present value of cash inflow is 232,714. That's what you have there. Present value of cash outflow is 200,004. Then raised to power 1 over 5. 5 is the useful life. Then multiply by 1 plus r. R is the 8%, so 1.08. So again, I don't need to waste my time doing all of this step by step. It's a waste of time. I will do this, I will do this, I will do, no, it's a waste of time. Use your calculator and get the number once and for all. How am I going to do this? Very simple. I know that 1 over 5 is 0.2. Therefore, I will say 232,714 divided by 200,004 equal, then raised to power 0.2 equal, then multiply by 1.08, multiply by 1.08 equal, then of course minus 1 equal, multiply by 100 equal 11.32 is the same answer that we got. Round it to 100%, sorry, to 11%. Therefore, since I need to go and compare this, I need to compare my calculated modified internal rate of return, which is 11%. I need to compare with the company cost of capital of 8%. Therefore, since the projects produce modified internal rate of return of 11% that is greater than the company cost of capital of 8%, it means the project is financially viable and should be undertaken. In case you are asked to advise, okay, just compare the 11% with the company cost of capital of 8%. This is how to calculate modified internal rate of return. No matter how big is the, once you get your net cash flow, if examiner likes, give you 2 pages, 3 pages of a question. Once you get the net cash flow correctly, every other techniques that you want to use is a good to go. So you can use terminal value, you can use NPV, you can use APV, you can use any techniques to get. Once you get your net cash flow correctly, every other one is straightforward. All right, straightforward. Okay, so let's pause for a few seconds, then let's move to the next one, which is the project duration. Let's talk about project duration. Okay, now what do you understand by project duration? Project duration can be likened to okay, let me use this one. Project duration can be likened to normal payback period, except that you are going to discount the cash flows that the project will generate to the present value equivalent. Therefore, again, just to brief you, by the time we get to bond valuation, you are going to see the same thing. The same way we want to calculate project duration now is the same way you are going to compute the bond valuation when we get there. So it's a plus for you if you understand it right now. So what is project duration? Project duration is simply the weighted average time taken to recover the amount invested in a project. Company wants to know how long will it take them to recover the weighted average of the time taken, okay, to recover the amount invested in a project. Of course, unlike the payback period and discounted payback period, the project duration consider all the expected future cash flows, okay, all the expected future cash flows, the project will consider it, all the cash inflows, the project will select it. But of course, as you know, the normal payback period or discounted payback period, immediately after you have computed the payback period, it will ignore other cash flows. But project duration consider all the cash flows. Okay, so of course you are expected to discount all the cash flows at the appropriate cost of capital. The higher the project duration, the riskier is the project, and vice versa. So if the project duration is shorter, just like you have the same decision rule, just like you have the decision rule for payback period, the same thing as this. So the shorter the project duration, the better the project, and the less risky is the project. But if the project duration is longer, then of course that means the project may be considered to be very risky. Okay, however, in relation to capital budgeting, duration can be computed using either weighted average method or present value method. So how do you calculate project duration? Okay, how do you calculate project duration? Like I said, project duration can be computed using either present value method or weighted average method. Whichever one that you use, again, you are going to get the same answer, except maybe with few or insignificant rounding error. Okay, so when you want to use the weighted average to compute project duration, before we talk about computing the computing project duration, note that when you are calculating project duration, if in the first year you are given negative cash flow, that negative cash flow should be ignored. Okay, when you are calculating project duration, if in the first year you are given negative cash flow, that negative cash flow should be ignored. However, if the negative cash flow occur in between years, then the negative cash flow should be included when computing the project duration. What do I mean by that? Say for example, let's take up this scenario here. We have a scenario. This is one scenario: year 1, year 2, year 3. In this case, you are given cash flows. The cash flow of year 1 is minus 2,000. Cash flow of year 2 is 1,200. Cash flow of year 3 is 2,000. Let me say 1,500, for example. All right. So when I'm calculating in this particular scenario, when I'm calculating my project duration, I will ignore the cash flow of year 1 because it is negative. So I will only compute project duration for cash flow of year 2 and year 3. That's all. I will ignore the negative cash flow. But another scenario is that, say for example, you have cash flows of, say, in year 1 is 1,000, year 2 negative 500, year 3 4,000 cash flow. In this case, I will include, you can see negative cash flow occur in year 2, but since the first year cash flow is positive, then I will include negative cash flow of year 2 in the computation of my project duration. So I will do for this, I will do for this, I will do for this, I will add everything together, I will get my project duration. Okay, so these are the things you need to take into, even if the negative cash flow occur at the final year, provided the negative cash flow is not from the first year, then you have to include the negative cash flow in the calculation of your project duration. So let's go back to calculating the project duration. Like I told you, there are two methods. You can either use weighted average method or you use the present value method. So if you want to use the weighted average method, so there are 3 procedures you are supposed to carry out. First thing first, you need to calculate the present value. Okay, calculate the present value of all the positive cash flows. Okay, calculate present value of the project. Okay, just calculate present value. This is the present value. You already know how to calculate present value. Cash flow multiplied by discount factor will give you present value, isn't it? Then step 2, calculate the weight of each of the cash flow of each year. Calculate the weight of the cash flow of each year. Say, how do you do that? Say, for example, this is A, this is B, this is C, this is D. D is equal to B multiplied by C. You already know how to do present value. Then E is A multiplied by D. This A here, then multiply by D. So that's how I'm going to get the weight. So I will just multiply the number of years with the present value. I will get this. Number of year 2 multiplied by this, I will get this. Number of year 3 multiplied by this, I will get this. I will then add everything together. Once I have that, then I will now move to step 3, which is to calculate the project duration. The project duration is the total weight divided by the total present value. Okay, total weight divided by the total present value. Okay, this is the duration here. Total weight divided by total present value will give me the project duration. That's it. It's as simple as that. So you can just, from this material, you can follow the procedure the way I listed it there. So it's as simple as that. Once you master the format, you are good to go. In recent time, in fact, for a very long time, I've never seen where I can tested the project duration. But again, it's good to know because you never can tell where examiner will ask you. All right, and that's why it's important for you to know it. Okay, then If you want to use the present value method to calculate the project duration, again, I can even shorten this one. Instead of 7 columns, I can shorten it to 5 columns. I will just remove this cash flow of a thing. I will remove it from the templates. Okay. So, but in any case, to get the, when you want to calculate project duration using the present value method, the first step you need to do is to calculate present value of each year. Calculate present value of each year. This is the first step. Okay. The second step, calculate the proportion of the PV. Calculate the proportion of PV of each year to the total PV. This is the second step. Okay. Calculate the proportion of PV of each year. How do you do that? To get the proportion of PV, you are going to take the PV of year 1, present value of year 1. You are going to divide it with the total present value. So you come and put it here. Present value of year 2, you divide it with total present value. You come and put it here. Present value of year 3, you divide it with total present value. You come and put it here. So that's what that. Of course, your proportion must be equal to 100% or 1, must be equal to 100% or 1, depending on which number are you using. Then, to now get the final duration, you are expected to multiply the number of years with the proportion that you have determined. All right. So this is step 3 now. That's your final answer. Whatever you have there is your final answer. So to get the duration, just multiply A, number of years, you multiply with E with the proportion. That will give you the duration. When you sum up everything, sum up this plus that. So that will give you the total. Whatever you have there as the total is the duration of the project. No need for other formula again. All right, no need for other formula. So this is the way to calculate project duration. You can either use terminal value, or sorry, you can either use weighted average method or you use the present value method. So you can read more. You can read more in all the explanation I've done in this material. Okay, then like I mentioned to you, the decision rule under duration is that the shorter the duration, the better the project, and vice versa. Okay, so let's have examples. Let's have examples to demonstrate our learning so far. Okay, then. A project with an annual outlay of 200,000 naira is expected to generate the following cash inflows for the next 6 years. All right. So the cost of capital is 10% required. Calculate the project duration. You will notice that in the cash flow given to us, the first year cash flow is negative. Therefore, when we are calculating the project duration, we are going to ignore that 40,000. Okay, we are going to ignore the 40,000. Therefore, let's demonstrate the two methods. Okay. Now, if you want to use the weighted average method, so you can see you create a column for a year, create a column for cash flow, create a column for discount factor, create a column for present value and the weight, because you want to use weighted average method. Therefore, you are going to ignore the negative cash flow of year 1. So that's why you see here in this table, we don't have year 1. So these are the cash flows for the respective years. So the next thing we need to do now, the cost of capital given to us in the question is 10%. Okay, that's the 10%. So at this point, all we need to do is to get the present value. So of course, you already know how to calculate discount factor. So discount factor, cash flow multiplied by discount factor will give us this. You get this, you get this, you get this, and then you get this. You know how to do all of this. So now we want to determine the weights. We want to get the weights of the duration, of the cash flows of the present values. Therefore, I would then say the cash flow of year 2, this year 2, multiplied by the present value of that year 2. So that will give me 49,000. That will give me 49,780. Year 3, I will say 3 multiplied by 19,120. That will give me 273.60. Okay. For year 4, I will say 4 multiplied by 102,450. That will give me 409,800. Okay. Year 5, 5 multiplied by 62,100. That will produce 310,500. Year 6, 6 multiplied by 28,200, okay, that will give me 169,200. I will add up all the weight together. The total weight is 1 million, okay, 1,209,640. Total present value is 307,650. Then I will apply the formula total weight divided by the total present value. That's the formula for project duration. When you slot in the number into the formula, we got 3.91 years. Okay, 3.91 years. Let me confirm that. So I will say 1,209,640 divided by 307,650 equal, that's 3.93. So there's a typo there. This is supposed to be 3.93. This is 3.93 years. Okay, that's a typo. Supposed to be 3.93 years. All right, so that's that. Then, so like I said, if I use weighted average method, the project duration is 3.93 years. Then let's use the alternative method, which is the present value method. So using the present value method, I will create these 6 columns. All right. So initially, I've already calculated the present value, which is consistent. But if you are using this method, so all you need to do is to just get your present value. This is the present value here. So the next thing, step 2 now, is to calculate the proportion of the present value of each year. So the proportion of the present value to the total present value. Therefore, how do I do that? I need to divide the present value of year 1, okay, present value of year 1 by the total present value. Say, for example, the year 1 present value is 24,780 divided by the total present value of 307,650. That will give me 0.08 and all of that. So if I multiply with 100%, say multiply with 100%, that will give me 8.1. That's 8.1 that you are seeing here. All right, that's the 8.1 that you are seeing there. So that 8.1, I need to multiply with number of years. So 2 multiplied by 8.1 will give me 0.16. I will go to year 2, do the same thing. I will say 90,120 divided by the total present value of 307,650 equal, then multiply by 100 equal. That's why you are seeing 29.3. That's 29.3 you are seeing there. So that 29.3 multiplied by 3 years, okay, year 3, that will give me 0.88, 0.88. All right, I will do the same thing for year 3. In year 3, present value of year 3 is 102,450 minus divided by total present value. Then, of course, I will get this one. I will get 33.3%. 33.3% multiplied by year 4. That will give me 1.33. I will do the same thing for year 5. So the present value of year 5 is 62,100 divided by the total present value of 307,650. That will give me 20.2. 20.2 multiplied by 5. That will give me 1.01. Okay, then I will do the last one. 28,200 divided by 307,650. That will give me 9.2%. 9.2% multiplied by 6. That will give me 0.55. Therefore, you add up all the duration together, that will give me 3.93, which is the same thing as the duration I got using the weighted average method. So this is how to calculate project duration. So like I mentioned to you, from the solution above, negative cash flow in year 1 is ignored in arriving at the project duration. So this is how to calculate project duration. Again, no matter how big is the question, you can see the two methods, they make use of a present value. So you already know how to just ensure that if, for example, in the question you are given inflation, you are given taxation, there's working capital, there is sales value, there's variable cost, there is taxation, there's all those normal things you do in calculating NPV. Once you get your net cash flow, you can do anything, you can use any technique and you are going to get it correctly. just ensure that your net cash flow is correct. Once your net cash flow is correct, every other techniques that you want to use, you are good to go. All right, you are good to go. So that's that. So today we have completed the discussions around modified internal rate of return and the project duration. So quickly, let's talk about discounted payback period. So once we are done with the discounted payback period, and that will be end of today's class. Okay, so what do you mean by discounted payback period? So the discounted payback period is the same thing as the normal payback period. The only difference is just the fact that the cash flows to be generated by the project will be discounted to the present value equivalent before computing the payback period. You know, the traditional method of investment appraisal using payback period does not consider time value of money. So you are using cash flow to recover the amount, you are using your cash inflow to recover the cash outflow or the amount invested in the project. However, the discounted payback period is saying that you cannot use just ordinary the cash flow, you have to discount it, you considering the time value of money. So you have to discount it to the present value equivalent before you compute the payback period. Therefore, the discounted payback period is the length of time the present value of cash inflows from an investment will recover or will recoup the amount invested in a project. So the time taken to recover to use the present value of cash inflow to recoup or to recover the amount invested in a project is a discounted payback period. Like I said, it is calculated the same way as the normal payback period, except that the cash inflows are discounted to the present value equivalent before calculating the payback period. So with the discounted payback period, the problem of the time value of money with the normal payback periods is settled, is resolved. All right. So how do you calculate the discounted payback period? In this case, let's find one of the cash flows. Okay, let's find one of the cash flows to calculate the discounted payback period. So there's a particular question we solve under NPV for Bala Blue Limited. So the cash flow of the project, the cash outflow of that project is 500,000 naira. In year one, we have cash inflow of 200,000. In year two, cash inflow of 180. In year three, cash inflow of 150. Then in year four, cash inflow of 110,000 naira. So ordinarily, when I want to calculate payback period, I'm supposed to deduct 500,000 minus 200. I will get the balance. Balance minus 180. I will get the balance. That balance minus 150. That's how I will be recovering the amount invested in the project. However, as far as the discounted payback period is concerned, you don't use cash flows to recover projects. You have to use the present value. This is the present value that you are going to use. So the cash flow generated by the project, you need to first of all discount it using the discounting factor. All right, you discount it to get the present value. Once you get the present value, then you can now recover the 500,000. So in this case, if I want to recover the 500,000, I will just say 500,000 naira. We are going to start from year zero. Year zero is the 500,000. So I will say 500,000 minus the present value of the first year of 181,800. So minus 181,800. This will give me 312,200, which means that at the end of year one, I have balance of 318,200 to recover out of the 500. Then I will then move to the next the next present value of cash inflow. I would then say minus the next present value is 148,680. 148,680. So this will give me 169,520. So at the end of year two, I've recovered up to the point that I have the balance of 169,520. Then I will move to the next cash inflow. Okay, the next cash inflow, the next present value of cash inflow is, I would say, minus 112, 650. So this will give me 56,870. So when you get to a point whereby the outstanding balance of 56,870 is less than the next cash inflow, then you put a dash and you compute your payback period. You cannot recover because you can see what you have, the balance that you have is lower than the next present value. That's why you have to put a dash. Then you compute your payback period. How many years have you recovered? 3 years. You have recovered this. You have recovered this. You have also recovered this. So that's why you are seeing 3 here. So that's 3. Then plus the outstanding balance of 56,870 divided by the next cash inflow. So at the end of the day, our discounted payback period is 3.76 years. Okay, this means that this project will pay back within 4 years. So using the discounted payback period, the project will recoup the invested capital of 500,000 naira within the next 4 years. Okay, within the next 4 years. Now, the decision rule of discounted payback period is the same thing as the decision rule of the normal payback period. We've not done it. However, of course, your decision rule should be based on the calculated discounted payback period will be compared with the management predetermined payback period. So if you are not given the management predetermined payback period, there is no basis for the acceptability. Therefore, so you cannot advise on that. So guys, this is the end of today's class. By the grace of God, we are going to continue in our next class. Okay, in our next class, we are going to be discussing the non-discounted cash flow method, payback period, and then accounting rate of return. Thank you guys. Again, remember to subscribe to my YouTube channel. I really need this because we need to promote the channel and then so that every other person can benefit from this high quality lectures. You can see it took time for us to be able, for me to be able to deliver this lecture, and then you can only encourage me by subscribing to my YouTube channel. Not only that, you also need to comment, because as you are commenting, you are building the channels, and every other person can also benefit. You can also share it. You can share with your friends. If you have any friends or brothers, sisters that are in the university or that are writing master's exams, either MSc, MBA, whatever, that are doing financial management, share with them. Let everybody benefit. It's for free. Okay, free. I'm doing it for you for free. You can see I'm not spending. You are not spending any. You are not paying me anything. All these lectures, I sell it at 20,000 naira for each day. For each subscription. So you can see I'm giving it out for you for free. You can see. Please encourage me by subscribing to my YouTube channel. Thank you guys. I will see you in our next class by the grace of God. Cheers. Bye.